My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to America. Other people want to make friends, just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. My mom always used to say that comparisons are odious. I finally understand why. Comparisons are constantly being used to scare you into taking no action. Even when you should be buying something hand over fist when the market gets annihilated, as it did earlier this week, before we got to this placid session, where the Dow inched up 38 points, S&P advanced 0.28%, NASDAQ gained 0.23%. Let me give you a classic example. Let's talk Tesla versus Ford. When Tesla's market capitalization passed the size of Ford Motor, which was a much larger company, at least in sales, a cacophony of Wall Streeters told you that Tesla obviously had to be overvalued and it had to be sold. But it turns out that Tesla deserved to pass Ford on the way to passing just about every other entity out there. It's now a $1 trillion company, for heaven's sake. If you sold it just because of the Ford comparison, boy, did you miss out on one of the greatest rallies in living memory. Yet back then, you were told over and over again that Tesla shouldn't have a higher market capitalization than Ford. An odious compare. Oh, then it was compared to Ford and GM. Oh, and then they had to throw in Toyota. At the time, this all seemed self-evident to the bears. They thought that Tesla's valuation was self-evidently absurd. Turned out the flip side was true. Few thought that Ford's valuation was too high. They certainly didn't imagine it dropping to the single digits while Tesla cruised higher and higher, which leads me to the curious case of all the people currently being left behind by this market. Something that feels almost tragic because stocks seem to want to lift right now, even when they aren't supposed to. I think regular investors are routinely misled by the whole brokerage house hedge fund journalist triad. It's not that they're out to get you. They're not. But they sure as heck aren't out to save you either. Even their neutrality can frighten you away from buying something good, especially when the market's down and it's easy to scare anyone out of their wits. Take the obsession with the Fed, and we all have it, right? The obsession with the Fed. Most of you see all of this harping about the Fed's lack of gumption when it's coming to fight inflation. That's the theme, right? So many commentators speak almost in unison to complain that Jay Powell dropped the ball, and now the American middle class, you, is going to have to pay the price at the pump, pay the price at the supermarket, and, of course, pay the price in your portfolio. The drumbeat got even louder today when we got a consumer price index number that's 7% higher than last year. I don't like that. Now, I know that lots of people share this view, but the thing is, many of the ones who come on TV to bash the Fed for not being hawkish enough, you don't know. Maybe they're actually trying to profit from your panic. If they can scare you into selling stocks, that gives them a better chance to cover the short positions. You've got to remember that many of the professionals who come on air are simply talking their book. They just won't say, listen, if you sell, I make a lot of money. As I see it, Jay Powell won't try to destroy the economy in order to save it because he already tried that once in 2018, and it was wrong, and he learns from his mistakes. This time he's emphasized that things are too hot, but he didn't beat us over the head with a schedule of rate hikes. He even did the unthinkable yesterday and said, I don't know if you caught the testimony, he said he was going to use common sense. Novel, right? Common sense decided when to tighten. This took a lot of hedge funds and their media acolytes by surprise. If you listen to these people, you would have missed out on yesterday's terrific move. Then there's the supposed sin of dip buying. All right, this one really bothers me. We compare the dips to the geniuses, right? The geniuses who don't do dips and the morons who buy dips. Every time the market tumbles, dip buyers come in to tell us to pick up some stock. Somehow these people are widely dismissed as idiots. Yet every dip in the last decade has been a buying opportunity. Historically speaking, it's a pretty good strategy, but you only hear it talked about derisively. And you know what? It does make me angry. Now, it's possible that the dip buyers come in too soon. Look, even a good strategy can be poorly executed. But it's absurd that we treat dip buyers as the height of idiocy. Of course you should be trying to buy stocks at lower prices. We should be praising anyone with the intestinal fortitude to buy Monday's dip, not hinting that they're a bunch of clueless lightweights who got lucky. They're always described as dopes who don't know any better. What a bogus comparison, and how unfair. Or how about this? How about this idea of index funds versus individual stock picking that I've been hearing again? Portfolio managers love to bash individual stock picking. It's a mug's game. Even when they're literally doing it, they're taking your money so they can do it. You got a whole cottage industry out there that exists to promote index fund and argue that stock picking is for jumps, as it's jumps. They can't coexist. You're either index funds or picking stocks, index funds smart, picking stocks dumb. I come back and say, what the hell? How did this become an either-or situation? Those of us who believe in stock picking have never once said you shouldn't go near index funds. The opposite. I like index funds, but I like individual stock picking for you, too. The whole proposition of CNBC's Investing Club, which we're really gearing up with some videos next week, is that you can learn to be your own professional money manager, side-by-side ownership of both index funds and individual stock picks from the recommended list we put together for my charitable trust. The insistence that individual stocks are dangerous, but when wrapped up in an index fund basket, they're fine. Well, isn't that a comedy of errors? Finally, let me give you the most pernicious of strategies that scare you into taking action by making you feel stupid. We have lots of ephemeral trends in this business, something that rises and falls in rapid fashion, and therefore should be avoided. We don't like fads here, but you need to be pretty nimble to take advantage of short-term fads, and that's not something I can do. I don't know if you can do it. I bet you can't. Yet Wall Street creates these endless ETF baskets to take advantage of the buzz of what people want, like cybersecurity, infrastructure, electric vehicle batteries, or buzz itself. They make you feel like you're smart for investing in an entire red-hot sector rather than trying to pick the best-of-breed operators, which is what we do here. That kind of faux diversification is applauded on Wall Street. They tell you that you're avoiding single-stock risk, even when the single stock may be the best performer in the group. Not helpful, gibberish. I point all of these out because, once again, it looks like we've had a decent opportunity to make money. Now, some of it's past. That was last Monday. One, it started when the stock market plummeted earlier this week. It was, for the moment, a real good dip. But if you roll back the tape, you won't hear all that many people coming out on air to say, buy that dip, even if that's what they might have been even doing themselves. They don't want you to do it, not because they're trying to help you save money, but because they don't want to get caught on YouTube saying anything positive in case the market keeps going lower, and it will be used against them for the rest of their lives. When bulls are wrong, they get torn to pieces. But nobody cares when the bears are wrong. You never see their tapes on YouTube. As a result, on average, most commentators are too bearish. Why not? They'll never look bad on YouTube. So I want you to do this. I want you to have a list of stocks you like and prices where you think they're worth buying. If you don't have your own, go ahead and use the ones we've already vetted for the Charitable Trust and the Investing Club, which really goes into high gear next week. The bottom line, when your favorite stocks hit those prices, you buy them. That's how you avoid getting scared out of your wits by people who want to make you feel like a moron for being rational. Let's go to Jeff in Alabama. Jeff.
Jim, many thanks for taking my call.
Quite welcome.
And many thanks for the invaluable information you're giving out on your daily newsletter.
Oh, thank you. Thank you. It's going to be really good. We got the what I'm looking at in the morning, and we're going to have videos. And then, of course, we have our intraday. We do all of our action before we let you take it ahead of us. What's going on?
Well, a few months ago, under the advice of my broker, I bought shares of Zoom. And immediately the prices, the stock share began to plummet. So after a period of time and enough pain, I sold my shares a few weeks ago. But the question here is, A, what went wrong, since Zoom seems to be a pretty good company, and wherever you go, people are Zooming. And the question is, what happened there? And secondly, now that it's down 100 points, is it now a good play?
Okay. These are great questions. Zoom has a great balance sheet. They have a lot of money, about $5 billion in cash. They have to diversify away from just being Zoom. That's why I like that 5.9 acquisition that did not work out. And that really hurt the company. I think they have to do an acquisition and make some very serious investments. My stepson works at Zoom but we don't talk about it. But I do think that Zoom, because they didn't get that deal done, that's why the stock's going down. People feel they're not aggressive enough in diversifying away after they have all that cash. Let's go to Jack in Ohio. Jack.
Hey, thanks for taking my call, Jimmy.
You're quite welcome.
I got in a few months ago before the run-up with a good dividend yield. It has too much good news to take any off the table. Is it okay to add more or enjoy the ride this year? ABBV, AbbVie.
Okay, AbbVie's been one of our biggest winners for the Charitable Trust, and we actually recently took some off because we thought that we had such a gigantic gain. So if I'm doing that, I cannot count as buying it here. We are anxious to buy if it comes back to the 100 area, which it continues to do. We'll pick some up, the stock that we sold. But right now, no, I can't tell you to buy if we just did some selling. We need to go to Denny in Florida. Denny.
Hello, Dr. Cramer.
Hi.
Thank you for the opportunity to seek guidance.
Excellent.
Now this is important, as Josh Brown would say. Charles River Laboratories represents 10% of my total portfolio, and I'm a retired veterinarian on fixed income. CRL declined rapidly following its peak in late September 2021. Do I continue to hold long term, sell a portion, or sell all, and move on to 2 or 3 of your charitable trust fund holdings for diversification? Now, my 13-year-old granddaughter, Bianca, and myself, your young and old disciples, express our sincere appreciation for your thoughts for a prudent way forward. You're the best, sir. Thank you, Tim.
All right, look, I think Charles River Labs is sensational. I think Foster's great. I think that this is one of the situations where it's a high-growth stock that sells at a high price, and people are selling those, but it's profitable. So it's one that you should be buying on weakness, not selling. And thank you for those great calls. I want you to have a list of stocks you like and prices where you think they're worth buying. When your favorite stocks hit those prices, you buy them. On Mad Money tonight, in the face of a volatile market, one of the most important things you can do is make sure you hold a diversified portfolio. And that's why we're playing My Diversified to see if the portfolios of Cramer got past the test. And investors have changed the channel on Viacom CBS. But is the stock now too cheap to ignore? I'm going to give you my take. Plus, how about the best stock of last year? That's Devon Energy. And it's already started the year off with a bang. So could the energy giant remain a winner in the new year? I'm checking in with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.